Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Do you think that whenever good things happen to the economy, equity investors make money? Well, you are wrong. No matter how good the event. Now take the greatest event in India's economic history, for example, the 1991 liberalization of the Indian economy. We just celebrated 30 years since that hallowed moment when then Finance Minister Manmohan Singh presented the budget before Parliament on July 24th, 1991. It was the budget that kicked off the reforms. If India's modern economic history has to be pinned down to the single most important event, this was it. These reforms changed the way India lives. In effect, it took us from living like ascetics to being spoiled for choice in every area of life. When the reforms were announced, investors were quick to realize that what was in store for the Indian economy. Naturally, they were excited. In fact, if the stock market was any indicator, excited would be an understatement. Elated about the prospects that lie ahead for the economy, and further spurred on by big bull Harshad Mehta, the BSE Sensex went on to see a price to earnings multiple of more than 55 times. Well, the reforms delivered. They brought on all the anticipated benefits to the economy over the next 30 years and more. The stock market, though, would never see such a valuation again, not even close. Investors who bought into these overheated markets in the name of liberalization were in for a rude shock. The stock markets would trade at or below that level for a large part of the next 12 long years, at times more than 50% lower. In their excitement, all calculations had gone out the window. Investors were willing to pay just about anything to get their hands on stocks. And when that happens, disaster almost always is just around the corner. Benjamin Graham summed it up way back in 1972. He said, "The habit of relating what is paid to what is being offered is an invaluable trait in investment." In an article in a women's magazine many years ago, we advised the readers, we as in Benjamin Graham, advised the readers to buy their stocks as they bought their groceries, not as they bought their perfume. The really dreadful losses of the past few years were realized in those common stock issues where the buyer forgot to ask how much. Be it liberalization, a new government, GST, or a great monsoon, you always got to ask the all-important question, everything said and done, am I paying too much for the stock in relation to its intrinsic value? For even though the company may turn out to do very well or the economy may have some great years ahead of it, when you pay too much, even a good stock can quickly turn into a bad investment. Now let us quickly consider the other side of the coin. I did a small Google search and landed upon an article that termed Pranab Mukherjee's budget of 2012 as the second worst budget ever after Indira Gandhi's budget of 1970. Did the stock market follow suit? Absolutely not. Once again, the stock market ignored the quality of the budget and moved in the opposite direction. Between March 2012 and March 2015, the Sensex climbed an impressive 60% and looked far from done yet. Once again, the reason was valuations. When Pranab Da presented his budget, the Sensex was trading at an attractive price to earnings multiple of almost 18 times, below its long-term average. In other words, it was quite attractively valued and therefore went on to give impressive returns over the next 3 years. Therefore, we saw two real-life examples. The first one where the benchmark index performed poorly despite one of the best budgets in Indian economic history, and the second one where it performed well despite one of the worst budgets in history. The key takeaway is simple. The quality of a budget has very limited impact on the 3 to 5 year direction of the stock market. Over this time horizon, it is the market valuation that matters more than an important economic event like a budget. Right now, the valuation stand at a Sensex PE multiple of more than 27 times, which is well above the long-term average. Therefore, even if the Finance Minister, Ms. Nirmala Sitharaman, presents a landmark budget tomorrow, I don't think it will have a huge impact on how the market moves over the next 2 to 3 years. Your returns over such a time period will be determined more by the overall market valuations, which I'm afraid are not that attractive. Therefore, I don't know whether the Finance Minister's budget will take Sensex to a new high in the near term. If it does, it will be more irrational exuberance, and it will be not a bad idea to book profits and take some money off the table. But if the budget scores poorly and the markets correct strongly, then it may be a good opportunity to buy a slice of India's future economic pie at a marked down price. Therefore, the idea is to be reactive and not proactive. We should see how the markets move and then react to it. If there is an excessive move in either direction, up or down, a sensible value investor should capitalize on it by moving in the opposite direction. This is how market-beating returns are earned over the long term. Let me know with your comments and likes what you think of this strategy. Goodbye and take care.
Our new research uncovers some shocking truths behind today's hottest investment opportunity, electric vehicles. Don't invest your money in EV stocks before seeing our research. Click here to sign up for our special event to know it all for free.